Welcome to Acera's pre-retirement seminar. So in this seminar, I'm going to tell you all the things that you might want to know in the 3 years leading up to your retirement, or maybe even in the 3 months or 3 weeks leading up to your retirement. Because you're going to retire soon, and you're probably going to have some questions. Questions like, what do I need to know? What do I need to do? Okay, so I have organized this presentation into the form of a checklist. So this is your pre-retirement checklist. And this is going to help you understand all the things you might want to know and do before retirement. And we're going to go through the whole checklist during the presentation. So I'm going to help you understand your membership. We'll talk about some details of that. I'm going to help you estimate your retirement benefit. I'm going to help you verify your retirement eligibility and choose your retirement date. And I'll tell you about the process that you actually use to apply to retire. We'll talk about other benefits, including medical, dental, and vision. And then we'll talk about a few life events that'll help you understand and about signing up for Acera News. So that's the whole checklist. So let's go ahead and jump right in. We'll get started with the first item on the checklist, understand your membership. Okay. So who is Acera? In one sense, Acera is an acronym, and it stands for the Alameda County Employees Retirement Association. But it's made up of a lot of people. So there are about 90 of us that work at Acera, and what we do is we provide retirement, disability, and death benefits to all of our members. So that's all of you. So you are also part of Acera. And you're part of Acera because of the position that you work in and where you work. So you work, or at some point you worked full-time in a retirement eligible position for one of the employers that participates in Acera, including Alameda County as our biggest employer. So all of these employers, their employees, including you, are earning an Acera retirement. So as a member, you contribute to Acera's fund. So every time you get paid, with every paycheck, you contribute to the fund. That is your employee contribution. Every time that happens, your employer also makes a contribution on your behalf. So we have this big pot of money called Acera's fund. And what we do is we invest it all over the world in a lot of different types of investments, with the goal of earning more money on top of the money that you've already contributed. And so these three sources of income, your contribution, your employer's contribution, and our investment earnings, give us this big pot of money that we call Acera's fund. So what do we do with that money? Well, meanwhile, you are earning credit toward retirement. So as you work in your job, you're earning credit toward your retirement. And then at some point in the future, you are going to retire. And once you retire and sit on the beach like this gentleman, if that's what you are going to do in your retirement, you will collect a retirement allowance for the rest of your life from Acera. So you're going to get that every month for the rest of your life. So you cannot outlive your Acera retirement. It's going to be guaranteed for your entire lifetime in retirement. So to get into the details of Acera a little bit further, this chart is really helpful, this pension milestone chart. This has a lot of the milestones on it that you will see regarding your retirement that you're earning in your job, the retirement that you're earning through Acera. And so this is kind of a high-level overview of the different milestones that you'll see, and this will help us dig into some of the details of how Acera works a little bit more. So let me go through these milestones. The first milestone on the chart is your first day of work. That's your date of hire. So if you started out in your full-time retirement eligible position, this would be the first day that they told you to show up to work. If you started out in another capacity, like you started out part-time or under contract or as a seasonal employee, this would be the first day of your full-time retirement eligible position. Okay, so then what happens is 2 weeks goes by, and then we have the first day of your second pay period. That is your date of entry into Acera. That's the day when you start earning credit toward retirement. Then 5 years goes by. After 5 years, you're considered vested in the retirement system. That's your vesting date. And so once you're vested in the system, vesting just means guaranteed. So once you're vested, you're guaranteed the vested retirement benefits. So you're guaranteed the guaranteed benefits, basically. And those include that lifetime monthly retirement allowance. Okay, so then the next milestone on the chart is the day that you actually become eligible to retire. And it's going to be based on your years of service credit, so like the years that you've worked and earned service credit toward retirement, and it will be based on your age of retirement. And there's some combination of those that will allow you to become eligible to retire. And we'll talk about the details of that later on in the presentation. So you become eligible to retire. And then after this date, any date that you choose can be your retirement date. And so this will be your first day of retirement. Once you hit retirement, this is the day where you start collecting that lifetime monthly retirement allowance every month for the rest of your life. Okay, there's 2 more dates on the pension milestone chart. The first one is your death. I'm sorry that has to be on here, but it is a fact of life. The reason it's on here is because between your date of retirement and your death is the time period when you're earning that, or when you're collecting that lifetime monthly retirement allowance that you've earned. Additionally, there's another date after that, which is if you have designated a beneficiary for a continuance after your death, which is a continuance is a continuing payment every month. If your beneficiary is going to be able to collect that for the rest of their life, then they would collect that until their death. And so that is also a milestone in that chart. And we'll talk about the details of who those beneficiaries can be and how you can leave a continuance to a beneficiary later on in the presentation. So those are the pension milestones. Okay. So this is a piece of the retirement worksheet that I have asked you all to download. And let me show you the whole thing here. So this is the whole retirement planning worksheet. So you should have printed out a copy of this already or just have it available. And this is available on that page on our website that you signed up for this seminar, on the retirement planning seminars page. If you didn't print it out, no worries. You can just take notes as we go along. So if you want to, you can fill this out as we go along, or you can fill it out later. And this is kind of your takeaway from this seminar. I've done this seminar for a lot of years, and previously I was having people come up to me after the seminar and say things like, "Oh, the seminar is so great, I finally understand all of this stuff. It's my 3rd time." And so I got to thinking, well, if you had to come 3 times, was it really that memorable? So what I'm trying to achieve with this worksheet is you can record all of the numbers that we discovered during the course of the seminar. And then when you come back later and what happened in the seminar, what you learned in the seminar is kind of foggy, you can refer to this worksheet to kind of review what you learned. Okay. So let me go back to the presentation. So this is the career timeline piece of the worksheet. So we're going to fill this out as we go along. The first thing that you can fill in, if you like, is your SERA entry date, if you happen to know it. For the purposes of this worksheet, these don't have to be exact, so I've written approximate dates up here. But if you happen to know that it was like November of 2007 or 2005, you can just go ahead and write that in there. Or if you just know what year it was, you can just go ahead and write the year in. The other thing that you might want to fill in at this point is your projected retirement date, if you happen to have already chosen a projected retirement date. If you haven't, it's totally okay, because we're going to talk all about choosing your retirement date later on in the presentation. You might want to fill this out in pencil, because maybe you'll hear something during the presentation that changes what you think your retirement date might be. Okay, just real quick on vesting. Like I said, it happens after you earn 5 years of service credit. So basically, you work 5 full-time years, you earn 5 full-time years of service credit, and you are vested in the system. And then you are able to access the guaranteed benefits that are guaranteed by state law. And those benefits are the monthly retirement allowance, a cost of living adjustment to that retirement allowance every year, and a $1,000 lump sum death benefit. Now, there are additional death benefits, which I'll talk about later, but this one is just kind of like this basic lump sum death benefit that everyone has access to. So now that you know your vesting date is 5 years after your entry date, you can fill that in. And the vesting date isn't super important, but it's just like for your reference. So you can just add 5 years to whatever you have in here. Just kind of get close. Okay, there's a question that you're trying to fill the form and it does not take. Yeah, it's not actually a fillable form. So this would be something that you would want to print out and then fill out with a pen. I don't think it's actually a fillable form. Yeah, so you would want to go ahead and fill that out with a pen. Or you could just use a scratch sheet of paper. Okay, so next topic, your tier. Okay, you are going to be in one of these tiers. And this will help you understand more of the details about how your retirement works. And it's based on your date of entry into ESERA. Now, you're going to want to figure out which row you're in here. So if you're a safety member, you're going to be looking at this row. Safety members are sheriff's deputies and probation officers and other sworn officers. Everyone else is a general member. So you would be looking up here, or if you're a general member who works for the housing authority, you would look here. Livermore Area Recreation and Parks District has actually a different row that I haven't added here, but it's out on our website. If somebody is watching this that works for LARPD, let me know and I can talk about that. Okay, so the way that you figure out your tier is based on your date of entry. So the tiers are separated by these dates. So for example, if you're a general member and your date of entry into ESERA is before July 1st, 1983, then you're going to be in tier 1. If it's on July 1st, 1983, or all the way up to December 31st, 2012, you're going to be in tier 2. If it's on January 1st, 2013 and beyond, you're going to be in tier 4. Okay, that's how that works. Housing Authority has different dates. So tier 1 lasts all the way up to September 30th, 2011. So if you entered ESERA before that date, then you would be in tier 1. And tier 2, if you entered between these dates, and tier 4 for all of them is January 1st, 2013 and beyond. For the safety members, tier 1 ended on July 1st, 1983. Tier 2B went all the way up until October 17th, 2010. And then if you entered between here and here, you would have made a selection between tier 2C and tier 2D. One of them is a slightly lower tier, one of them is a slightly higher tier. So one pays a little less, one pays a little bit more. So you would need to know which one you had selected. If you don't remember which one you had selected, you can log into your account on our website and it will tell you which one of those 2 tiers you're in. Okay, so now that you know what tier you're in, you can go ahead and mark that out on the worksheet. If you're a safety member, you may have actually done some general work, so you may have some time as a general member, so you could mark your tier as a general member and your tier as a safety member on the same worksheet, or you could do 2 different worksheets. Okay. So the next item on the checklist, now that we have some of the pension basics out of the way, is estimating your retirement benefit. So first of all, let me tell you how your retirement allowance, that monthly pension allowance that you're going to get in retirement, let me tell you how we calculate that. So in retirement, you are going to get a percentage of your highest salary that you were earning while you were working. You're going to get a percentage of your highest salary for each year of service that you work, each year of full-time service that you accrue as service credit. So let me help you understand what that means. Okay, let's say, now your age factor percentage is going to be based on your tier, and I'll talk more about that in a little bit. But let's say for this example, you're going to get 2% of your highest salary for each year of service credit. And while you worked during your career, you earned 20 years of service credit. Okay. So if you're going to get 2% of your highest salary for each one of those 20 years, that means you're going to get 40% of your highest salary in retirement, because you're getting 2% of your salary for each one of the 20 years. So if you multiply that 2% times 20, you get 40%. So you're going to get 40% of your highest average monthly salary. So let's say your highest average monthly salary, just to give you an example with some nice round numbers. Let's say you were making, on average, $5,000 per month while you were working. Well, you're going to get 40% of that amount as your lifetime monthly retirement allowance, which is going to be $2,000. So this is what you would get in your retirement allowance check every month from Sarah. So that's how that works. Let me talk about each one of those factors in the formula in a little more detail to help you understand it a little bit better. So we'll talk about the age factor percentage first. So in the example I gave you, I showed you the example of a 2% age factor percentage, but it's going to probably be something different for you, and it's based on your age at retirement. So however old you are at retirement, and whatever tier you're in, we're going to use the percentage from this chart for your retirement formula. So for example, if you're a tier 2 member and you retire at age 62 and you're a tier 2 general member, 2.09% would be the percentage of your salary that you're going to get for each year of service. If instead you waited until age 65, you would get 2.43% of your salary for each year of service. So you can see that for all of the tiers, the percentages get higher the longer you wait to retire. Okay, and you can just only look at your tier. You don't have to look at any of the other numbers. So if we've identified that you're a general tier 2 member, you can just look at this set of numbers. If you're tier 1, this set of numbers. If you're safety and you're in general and you're in tier 1 or tier 2B, you can just look at this set of numbers. So you'll notice, like I said, that the percentages get higher the longer you wait to retire. So the older you are when you retire, the higher the percentage of your salary that you're going to get for each year of service, up to a maximum for your tier. So that's what the blue boxes are trying to represent here. So if you retire at the maximum age factor percentage for your tier, the maximum age, you're going to get the maximum age factor percentage. If you retire older than that, you're still going to get whatever that maximum age factor percentage is. So for general tier 2 members, it's 2.43%. For tier 1 members, 2.62%. Tier 4, 2.50%. Safety members who are in these two tiers, 3% at age 50. So that's the maximum age factor percentage you can get for your tier. Another thing that you might notice about this chart is that this is just a sample of some of the age factor percentages. I skipped a bunch of the ages because they don't all fit on the slide. And that is because the percentages will actually increase every 3 months, so every quarter year. So if this were the whole chart, it would say 50, 50 and a quarter, 50 and a half, 50 and 3/4, 51, and so on and so forth. And every 3-month increase, every 3-month increase in your age will give you a slight increase in the age factor percentage that you will get. So every time you pass that quarter year date based on your birthday, you'll go up 1 notch in the age factor chart and you'll get a slightly higher age factor percentage. And when I say it's based on your birthday, just to give you an example, if your birthday is January 15th, 1 quarter after your birthday, so 3 months after your birthday, would be April 15th. So January, February, March, April 15th. And then 3 months after that would be July 15th. 3 months after that would be October 15th, and then back to your birthday on January 15th in this example. So every time you pass one of those days based on your birthday, then you go up one notch in this age factor chart and you get a slightly higher age factor percentage. Okay, any questions on the age factor percentages before I talk about the other two factors in the formula? Okay, if you think of one later, let me know. So the second thing I'll talk about, the second factor in the formula, I'll talk about service credit. So you start earning service credit, back to our milestone chart that we looked at before. You start earning service credit on this day, on your first day of ACERA membership, that also known as your date of ACERA entry or your entry date. And you will earn credit all the way up until you retire or you leave work before retirement. So you're going to be earning service credit your entire career while you're working. You earn service credit during your regular work hours. You also earn service credit during your earned vacation, sick leave, management leave, comp time, holidays, floating holidays. So all these types of earned leave, you earn service credit during while you're out on that leave, so those don't count against you. Now you don't earn service credit anytime you are on leave without pay. You're not earning service credit. If you purchase additional vacation that is on top of your earned vacation, while you're out on your purchased vacation, you're not earning service credit. Also, if you sell vacation, so you don't take so you have your earned vacation that you sell back to your employer, you don't get service credit for that, but you may get salary credit for that in the retirement formula for the salary factor, which we'll talk about in detail a little bit later. You also don't earn service credit for overtime, on-call time, standby time. Okay. There are some types of time that are eligible for you to purchase as service credit to increase the amount of service credit we have in the formula for you. And some examples are part-time work that you didn't earn service credit for. Like I said earlier, if you started out part-time before your full-time retirement eligible position, and that wasn't working for a temporary agency or under contract or anything like that, it was just plain old part-time, that's purchasable. Or if you worked for the county's temporary assignment pool, or project work before your full-time retirement eligible position, or the days before your ACERA entry date, between your date of hire and your date of entry, or any unpaid medical disability or military leave during your membership. Redeposits of prior memberships, other work that you did for other public agencies in California is purchasable. So there's a full list on our website, on our purchase page. And I'm not going to go into detail about purchasing service credit right now because it's, there's a lot of information and we need to talk about other topics. But if you want more information about that, go ahead and check out that page. There's a lot of information there about what types of time are eligible for purchase and how to purchase and how to determine whether it's worth it or not. So the last thing I'll talk about regarding service credit is around your unused sick leave. So what happens to your unused sick leave when you stop working and retire? So if your last day of work is the day before your date of retirement, which means you're going straight from active employment into retirement, we will convert your sick leave to service credit. So you will get half of your sick leave as service credit. So we'll take your unused sick leave, we'll divide it by 2. So you're basically getting half of your sick leave as additional service credit. Now there's a cap on this, and it's going to be in your memorandum of understanding, your MOU. And so it will say how much sick leave at retirement is convertible to service credit. For a lot of the MOUs, the cap is 125 days of sick leave. So that would convert down to 62.5 days of service credit. So if that was your cap, we would divide it by 2 and you would get 62.5 days of service credit, which would be about 12 work weeks. Some of the MOUs don't have a cap, like Acmeon doesn't have a cap, and Unrepresented People who follow ACME don't have a cap. So you're going to have to look in your MOU to see what the cap is. But basically, you're going to get half of your sick leave up to the cap as additional service credit. So that's service credit. So we talked about the age factor percentage. We talked about years of service credit. So let's talk about your highest average monthly salary. When you go to retire and we need to calculate your highest average monthly salary, we're going to look for your period of highest pay during your career. So we have all your payroll records in our database so that we can do this calculation. So we're going to look for your highest period of pay, and that's what we call your final compensation period. So that's just our pension terminology for your period of highest pay. For tiers 1 and 3, it's going to be your 26 highest consecutive biweekly or 12 monthly pay periods. For tiers 2 and 4, it's your highest 78 biweekly or 36 monthly pay periods. So for tiers 1 and 3, it's essentially your highest year of pay. And for tiers 2 and 4, it's essentially your highest 3 years of pay. Our goal is to find your highest average monthly salary. So what we're going to do to get the average is divide your total pay during that period by the number of months in that period to get the average. So for tier 1 and 3, we'll divide by 12 months. For tiers 2 and 4, we'll divide by 36 months. So that's how we arrive at your highest average monthly salary. So it's what you made on average per month during that entire final compensation period. So what types of pay are included in this salary that we're going to use in the pension formula to calculate your retirement? So your base pay, of course, is going to go in there. Some other types of pay can go in. Sometimes these are called footnotes. These are other pay codes, and they're usually based on different skills or different education levels that you have. And if you're receiving these other pay codes, I can't tell you off the top of my head whether your pay code is going to be included in this formula. But what you can do is you can go to this page on our website, estimator.org/paycodes, and there will be a list of the pay codes for your employer. And so you just find your pay code on the list by number or by name, and it'll say yes or no whether it's in or out of this equation. If you don't know the name or number of your pay code, you can ask your payroll manager for more info, but I do know that overtime never counts. Okay. Okay, so I have a question. How is a recent pay increase, how does that affect your pay since it will not be in the 12 months? So just to go back a slide, because some people do get like pay increases during this final compensation period. So if you're going to retire soon and you've recently gotten a pay increase, let's say that you're a tier 2 member. So we're looking at your highest 3 years of pay, and you've recently gotten a pay increase and you're going to retire within the next 3 months. Well, we're basically going to be looking at 36 months of pay. So for 3 months of that 36 months, you have gotten a higher pay. So it's going to increase your retirement, your highest average salary over that time by a little bit. So it will increase it, but just by a little bit, because it's not that small time period doesn't represent a large chunk of the total 3 years that we would be looking at here. For tier 1 members, that would be a little bit different, because 3 months worth of higher pay would be a quarter of this year time period. So it all depends on which tier you're in and how long you're going to be getting that higher pay. If you've gotten a raise and you're going to work another 3 years and you're in tier 2, then you're going to get higher pay for the entire final compensation period. So that's how that works. Okay, so yeah, tier 1. So the person that wrote in is tier 1. So yeah, if it would all depend on like how soon you're going to retire and how long during that year you're going to be making that pay. If it's like half of that 12-month period, then that would be a pretty significant increase. Okay, so we know that your base pay and footnotes are going to go into this final compensation, this what we call your final compensation, what we also call your highest average salary calculation. There are two other types of pay that can go in here, and that Sarah is required by law to put in here if this applies to you. So this does not apply to Tier 4. Okay, so Tier 4 members could take a snooze right now. Sorry, we're going to talk about this for like 20 minutes maybe. So you can go about your business. For all the other tiers, we're going to look at these two types of pay: vacation sales and vacation cash out, also known as vacation payoff. Okay. So what we're talking about is your final compensation period. So this is your period of highest pay, your Tier 1 or Tier 3 highest year, or your Tier 2 highest 3 years. So the two types of pay we're talking about are vacation sales and vacation cash out. Vacation sales is when, or vacation sell, is when you sell your vacation to your employer while you're still employed. So this is your earned vacation that you've earned as one of your benefits. If you sell that to your vacation, if you sell that vacation or some of that vacation back to your employer while you're still employed, that's considered a vacation sell. Okay. Vacation cash out or vacation payoff, also known as vacation payoff, that is when you have vacation left over on the books that you haven't used yet when you stop working and or retire. If you have leftover vacation at that point, they will cash you out for that amount, which means your earned vacation that you haven't used, they'll write you a check for that. So you'll get pay for that. And so this is at the time of termination or retirement. So if you get paid for your earned vacation that you're not going to use by either selling it to your employer or by simply cashing it out and having it left over when you stop working, that is, and that occurs during your final compensation period. We're going to look at that as vacation compensation that we might include as salary in this salary calculation. And we're going to be looking at the total amount of that between how much you sell and how much you cash out. So we're going to add them together. And so we're going to be looking at this total vacation compensation during the final compensation period. Okay, now if you sell vacation or you cash out vacation during this final compensation period, that is going to make your total salary during your final compensation period bigger. You made more money during that final compensation period because of that vacation pay. Now, if your total salary gets bigger during your final compensation period, that also means your average salary is going to be larger over that period. Because your average salary is one of the multipliers in the retirement formula, your retirement allowance is going to get bigger. So the bottom line is that if you sell vacation or cash out vacation, and that occurs during your final compensation period, your retirement allowance is going to be larger. How much larger? Well, just to give you an estimate of what the effect of getting paid for your earned vacation during this final compensation period would be on your retirement allowance. If you're in Tier 2 and you are able to cash out 8 weeks of vacation, for example, so 8 weeks of your earned vacation, you either sell and or cash out, that would increase your retirement allowance immediately at the time of retirement by about 5%, and that would last for the rest of your life. So your retirement allowance at retirement would be 5% higher, and you would get that higher retirement allowance plus cost of living adjustments every month for the rest of your life. If you were able to cash out more than that, like 12 weeks, it'd be about 7%. 15 weeks, almost 10%. For Tier 1, it's a little bit easier because it's a much shortened final compensation period. So if you were able to cash out 3 weeks, it would be about 5 or 6%, and 5 weeks would be almost 10%. These are just rough numbers, okay? But the reason I'm saying I'm using language like if we can include that much in your salary for the purposes of calculating your retirement is because there's a cap on how much of that vacation compensation we are allowed to include by state law. So the law says that if you sell vacation and or if you cash out vacation during this final compensation period, we must include that vacation pay in your salary up to the cap that is written in the state law. And we cannot, the law also says we cannot include vacation pay over that cap in your salary calculation. So let me show you what the cap, let me help you figure out what the compensation limits are going to be for you. Okay, so we're going to go back to the worksheet right now because it's easiest to do it in the worksheet to show you what the law says the caps are for how much vacation compensation can be included in the calculation. And I'm going to talk about Alameda Health System employees first, and then I'll talk about everybody else in just a minute. So you go to your worksheet, and what you're going to need to know is hours of paid time off that you earn per pay period. Okay, so you're going to put that in this field right here. So just to give you an example, maybe you earn 6.7 hours of PTO per pay period. The more decimal places you can put in there, the more accurate this calculation is going to be. So what you do is if you're in tier 1, you just multiply that number by 26, and that tells you how many hours of vacation you can cash out and or sell that we can include in the calculation. If you're in tier 2, you multiply it by 52, and that is your limit. Okay, so that's how you do that math. So for Alameda Health System employees, in order, what you're trying to do is maximize your earned retirement that a SARA must calculate based on the law, you would simply just want to have this limit on the books when you retire. So it's pretty simple. Okay, so now we'll do the county and the other employers. Okay, so if you work for the county, or you work for one of our other employers, you're going to use this part of the worksheet. You're going to first fill out the earned box and then the payable box. So your earned vacation, what you put in here is the weeks of vacation that you're earning per year at retirement. The county and the other employers have a system for determining how many weeks you earn based on your seniority, like based on how many years that you've worked. So for example, I think for the county, if you've worked over 21 years, you're earning 5 weeks of vacation per year at retirement. And then if you're earning maybe, I can't remember all the gradations, maybe it's like between 15 and 21, you're earning 4 weeks per year. Whatever it is for you, you put that number of weeks in this blank right here. Payable is the weeks of vacation you're allowed to sell per year. So somewhere in your employees' rules is a limit on how many weeks of vacation they will allow you to sell per year. And it may even be based on your position. So sometimes managers are allowed to sell 3 weeks per year, and non-managers are only allowed to sell 2 weeks per year. If you don't know what this number is, your payroll clerk will know what this number is, and or your HR representative. So you're going to put those two numbers in here. So for this example, let's say that you earn 5 weeks of vacation per year, and your employer will let you sell 2 weeks of that earned vacation each year if you want to sell it. Okay, so you put those two numbers in here. You're going to need, based on these two numbers, to get a limit, what your limit is going to be from this chart that I'm about to show you. So here's the chart. So in this example, we're gonna take that earned number and we're gonna go down to the 5 row here. So you earn 5 weeks of vacation per year. In this example, you're allowed to sell 2 weeks of that vacation per year. So then you come over here and you find your tier. If you're in tier 1, you look here. If you're in tier 2, you look here. So in this example, if you're in tier 1, your limit would be 4 weeks of vacation pay would be the maximum a SARA would be allowed to include in your salary calculation. For tier 2, 8 weeks of vacation pay would be the maximum. So you take that number and then you come back over to the worksheet and you put it in here. So this is going to be your limit, your personal limit. You're all going to have a different limit based on what your two numbers are. Okay. Now that we know your limit, if you are going to try to plan out selling vacation and cashing out vacation to see how much of that, to see the limit, like to get up to the limit of how much vacation a SARA can include in your salary calculation. What you're going to want to do is just simply either sell vacation or cash out vacation, some combination that gets you up to this limit. So for example, you could simply just cash out 8 weeks of vacation and sell 0. You just simply have 8 weeks of vacation left on the books when you retire, and you don't have to sell any, and that gets you up to the 8. Okay. Now, let's say that, let's take a different example. Let's say that you earn 5 weeks of vacation and you're allowed to sell 3. Okay. The limit from the chart is higher because this number went up, the limit is going to go up. So that goes up to 12. Okay. So in order to get up to this limit, you would need to think about one additional thing, and that is that your employer will only cash you out for 2 times your accrual rate of vacation. So if you have more than 2 times your accrual rate of vacation on the books when you retire, you would lose anything above 2 times your accrual rate. So for this person, this example, 5 times 2 is 10. 2 times their accrual rate of vacation is 10. This is the maximum amount of vacation that your employer will cash you out for. Okay, so if you have more than 10 weeks of vacation on the books when you retire, let's say that you have 11 weeks, that extra week above the 2 times your accrual rate, that disappears. That goes poof. You don't get paid for it. You don't get salary credit for it in this calculation. You don't get anything for it. Okay, so if you can't get up to the limit based on this limitation right here, then you may need to sell vacation if you can't get up to the limit with the cash out, which would mean that you would need to sell 2 weeks of vacation and then have the 10 weeks on the books, and then that would get you up to the 12. Okay. If you are in the previous example where 2 times your accrual rate is 10, and you can easily, and so you can get up to your limit, 8 is less than 10, and you don't need to sell any. Okay, it's just if you can't get up to the limit because of this rule that your employer has that they won't cash you out for more than 2 times your accrual rate, like if you can't get up to the limit, then that would be when you would have to sell. Okay. Some people have already sold a bunch of vacation. So what happens if you've already sold a bunch of vacation? So let's say that you've already sold, let's say you're in this scenario where 2 times your accrual rate is less than your limit, and you've already sold a bunch of vacation. What are your options? Or even if you're in the other scenario where your limit is 8, but you still sold a bunch of vacation, what are your options? Well, your first option is to cash out the difference. So in this example, you've sold 6 weeks of vacation while you're still working. Okay. And you know your limit from the chart is 12 weeks, whatever your limit is. In this example is 12 weeks. So you would just simply cash out the difference. So when you subtract 6 from 12, you get 6. And so you just cash out enough to get you up to the limit, basically. Option number 2 is you can cash out more if you want, and that's okay. So you've already sold 6, and let's say that you're going to have more than 6 on the books when you retire. You're going to have 10. That's totally fine. You're still going to get paid for this 10 weeks of vacation that you cash out of retirement, and you will still have gotten paid for 6 weeks of vacation that you sold while you were still working. You get all that money. All that money goes into your bank account. Okay. Now, when a SARA goes to calculate your retirement, we need to limit your vacation pay by law to that 12 weeks of vacation. What we're going to do is we're going to pick out the 12 weeks of vacation from this 16 that you got paid for. We're going to pick out the highest 12 that you got paid. So it's going to be this 10 probably, because you probably got paid more for this at the end of your career because of cost of living adjustments and raises. And then we'll find 2 other vacation weeks of vacation sales to get you up to the 12. And so that's how that works. So cashing out, getting paid for more than your limit doesn't count against you. You still get all the cash. It's just we're going to have to limit the vacation pay and the salary calculation to whatever your personal limit is. Okay, now I have a question that somebody asked, does that include sick leave? This does not include sick leave. So sick leave only affects the service credit factor in the formula. So your amount of service credit, so remember the three-factor formula, the age at retirement, years of service credit, and salary. So the sick leave only affects the service credit. If we cash out your sick leave, so you get half of your sick leave as service credit, that makes your service credit number go up, but that does not affect your salary number. Now separately over here, with the vacation, selling the vacation or cashing out the vacation, that makes your salary go up, but that does not make your service credit go up. Okay, so the selling vacation makes your salary go up, the sick leave conversion makes your service credit go up. Okay, so before we move on, and welcome back to Tier 4 members, what questions can I answer about this, about the limits on vacation pay that can be included in the salary calculation? Okay, we have one question. So you're Tier 1 and you're in 5 weeks per year. Should you sell weeks before you retire in November? So I'm going to assume that you're talking about this November. Do you happen to know this number? So we know that you earn 5 weeks per year. Do you know how many weeks of vacation you're allowed to sell per year? Okay, so 2. So going back to the chart, you earn 5 weeks per year. You're allowed to sell 2 weeks per year. So your limit is going to be 4. Okay. So if this is your worksheet, you would have 5 here, you would have 2 here, but since you're in Tier 1, your limit is going to be 4. Okay. So you would want to have some combination of vacation sell and vacation cash out to get you up to the 4 if you're trying to get up to the 4, like if that's what you are wanting to do. Because you're in Tier 1, what you actually don't need to sell any. You can just use this as an example. You would just want to cash out 4. So just have 4 weeks of vacation on the books when you retire. They'll cash you out for that 4 weeks, and you will get your limit of vacation pay in your salary calculation. So don't even worry about selling any. And that goes for everyone who is in the scenario where, yeah, sure, you're welcome. Everyone who's in the scenario where 2 times your accrual rate, so in this example, it's 10. If your limit is less than 2 times your accrual rate, you don't even have to worry about selling. You just have that limit on the books. If you're trying to maximize this, you just have that limit on the books when you retire, and it's nice and easy. Any more questions on how this vacation stuff works? Okay, I'll go ahead and move on. Okay, Tier 4 members, welcome back. Sorry we had to go through all that, but yeah, the Pension Reform Act of 2012 that took effect on January 1st, 2013, that created Tier 4, that act eliminated that ability to have vacation pay included in the salary calculation. So that it doesn't count for Tier 4 members. There are some limits on your monthly payments in retirement. And we'll just go through this quickly because it's not going to apply to the vast majority of people. The main one that people might hit up against is this limit right here. Your highest average monthly salary. So your retirement is capped at 100% of your highest average monthly salary. This is basically trying to make sure that you're not earning more in retirement than you were earning as you were working. For Tier 1 members, you have to have like 30 plus years and be of a certain age to hit this limit. For Tier 2 members, it's like 40 some, maybe 45 years or so, and be toward the top of your age range for Tier 2 to hit that limit. We find that most people retire with 20 years of service credit, so you're not even going to be anywhere near 100% of your highest average monthly salary. So that's just something to think about. These next two are for people with really high salaries, so I won't go into them because it doesn't apply to the vast majority of people. But if you have a high salary, you're going to want to be cognizant of these two limits. This one right here, Tier 4. For the Tier 4 members, the amount of salary that we're allowed to include in the salary calculation for the pension formula is capped. There's an annual cap on it. So if you make more than 126,291 annually for general members, or 151,549 annually for safety members, we cannot include any more salary than that in the calculation when we're calculating your highest average monthly salary. Now, that's the bad news. The good news is that any salary, while you're earning it, any salary that you earn above that cap, we don't take out retirement contributions for, because you're not going to get a benefit for it, so we don't take out contributions for it. So that gives you more money to save in like your 457B or your other savings to have more money at retirement. These caps go up every year. It's based on the Social Security wage index limit. So whenever these go up, we post the new limits on our website. Okay. So let's talk about estimating your retirement allowance. So now that we've gotten all of that preliminary stuff out of the way, let's talk about giving you an estimate of what your retirement allowance is going to be. Okay. I'm going to show you two ways to do it. The first is going to be this ballpark estimate way. So this is the estimating your retirement section on your worksheet. So for this ballpark estimate, we're going to use a ballpark estimate table, income replacement table. And so what we're going to want to do is just kind of get a rough estimate, just basically what age are you going to be in your imagined retirement scenario. Okay, so you put that in the worksheet. Then in this same scenario, roughly how many years of service credit will you have earned at retirement in this scenario? So what we do is we go out to our web page, and I'm actually not sure if this link still works, but if it doesn't, I'll fix it after the presentation. But let me show you how to get there without the link. So let me do a new screen share here. Okay, the reason that might not still work is because we just launched our new redesigned website. About 2 weeks ago. So the way to get there is you're going to go under members and you're going to go down to planning your future retirement income. Okay, so the first step is get an estimate. And option number 1 here is using an income replacement chart to get a quick ballpark estimate. So this is where you get the chart from. So what you're going to do is you're going to click on the button for your tier. So let's take general members tier 2. I always use them as an example because almost everyone is general tier 2. And so this gives you the income replacement percentages for all these different scenarios based on your age of retirement and your years of service credit. So in that example, I think we're using age 58 and 29 years of service credit. So what you do is you go to 29 years of service credit, you come all the way over here to age 58, and that is 50.03%. So that means you're going to get, in this scenario, you would get 50.03% of your working salary as your retirement allowance. So then you come back over to the worksheet, and you put in that percentage that you got from the chart. Then what you're going to do is put in an estimate of your highest average monthly salary. You can just kind of estimate based on what your current salary is, if your salary hasn't changed in a long time, based on what you make per month. If you want to get a closer estimate, you can log into your account on our website, and if you use the benefit estimator, it will give you a highest average salary estimate. And then you just multiply these two numbers together. So you're going to get 50% basically of your $6,000 highest average monthly salary, which is about $3,000. So that's how that quick ballpark estimate works. Okay. Method number 2 is I'm going to show you how to get a precise estimate with our online benefit estimator. So what you're going to need for this is you're going to need a separation date and a projected retirement date. Okay. Your separation date is your last day of work, and your projected retirement date is your first day of retirement. Now, if you don't really know what day you're going to retire yet, you can just kind of pick a date that kind of fits the scenario that you're thinking about. So if you're going to retire 3 years from now in the fall, you could pick October 1st, 3 years from now, and use that as your date, as your projected retirement date. And then if you're going to work straight into retirement, so you're going to retire straight out of active work, your separation date would be the day before your projected retirement date. If you're going to stop working and not retire yet, then you would want to put in the date that you think you might stop working, and then the day that you think you're going to retire. So there could be a big gap between these, but for everyone who is going right into retirement, the projected retirement date will be the next day after the separation date. Okay, then you go to our website, and so this is an old screenshot. This is actually our old new website, but the concept is the same. You're going to click on the account login button, and you're going to get into Web Member Services, which is our member portal that gives you access to your Acera account. The first page you're going to see is this account summary page that has a lot of your pension data that we have for you, like your tier, your date of entry, whether you have reciprocity, how much service credit you've earned, what your contributions are that you've paid into the system. What you're going to want to do is click on this estimate a benefit link here, and this is going to take you to the benefit estimator. And you're going to use those two dates that you put in on your worksheet right here and here, your separation date and your projected retirement date. So I'm just going to zoom in here so you can see it a little bit better. And you put in your dates and you hit calculate, and it's going to project in this scenario that you're doing how much service credit you will have earned in this scenario. Additionally, you are going to want to, additionally, it will give you a highest average monthly salary projection based on your payroll records. If you want to, you can override those two numbers. So if you know that you're going to make a service credit purchase, you're going to purchase a bunch of service credit, you can increase your service credit here. And if you're going to do that, what you do is you add the amount of service credit that you think you're going to get to this number, and you put the total in this to override your service credit. You can override your salary here. So for example, if you're going to retire like 3 years from now and you think you're going to get cost of living increases or raises, you can see what the effect of those would be if you increase your salary here. For this box right here, hours of cash vacation compensation, I'm going to show you how to put in hours of cash vacation compensation here if you want to and not overestimate. So this is if you're wanting to know the effect of selling vacation and or cashing out vacation, how much that's going to affect your retirement allowance. You can get an estimate with that included by putting hours of cash vacation compensation in the box. But you can, so you can leave it blank for now if you want, and you can click get estimate. Okay, so let's actually show you how to do this box. Okay, So the first thing that you're going to do, you go to this area of the worksheet, how to calculate hours of cash vacation compensation for the online benefit estimator. Okay, the first step is to run an estimate and leave that field blank. Okay, so you run an estimate, you leave this blank, you hit get estimate. And so you do that. Okay, then the next thing that you're going to do is put in the limit from the chart, from that other part of the worksheet. You put in whatever your limit of hours of cash vacation, or I'm sorry, your limit of weeks of cash vacation compensation is whatever that is for you. You put that in right here. Okay, and then you put in how many hours you work per week, because what our goal is to figure out what your limit is in hours. So we're going to multiply your limit in weeks by the amount of hours you work per week and get your limit in hours. Now for AHS people, we already know what your limit is in hours because that's the worksheet gave it to you in hours. And so you can just start here and you put your limit in hours. Okay. So then what you're going to do is you're going to take this estimate that you ran by leaving the estimator blank, and you're going to figure out how many hours of vacation you sold during the salary date range on this estimate. So whenever you ran the estimate, you got this PDF. And this box right here, it's pretty small, so it's hard to see, but it's the date range that the system is using to calculate this estimate. So it's the date range that it's looking at your payroll records to figure out what your salary is during that time, to make an estimate of your salary so that it can give you the salary calculation. Because it's looking at your salary during that date range, if you sold vacation during that date range, that's actually going to already increase your salary for this estimate. So the reason that we're doing this is because we don't want you to overestimate. So we're going to want to subtract out any vacation that you already sold during that date range. So in this example, let's say that you sold a week's, you know that you sold a week's worth of vacation during that date range. You're going to want to subtract that out from your limit in hours, and get. So in this example, you would get 56 hours. And that is what you're going to want to put in here. So what I'm trying to help you do here is not overestimate. If you had put in 96 hours here, you would get an overestimate, because for this number that it's using here, it's already including that 40 hours worth of vacation that you already sold during the day range that it's using to calculate this number. Okay. So you would put 56 in here, and then you hit get estimate. And then just to zoom in here, this is your estimated monthly retirement allowance for each of the different retirement options. I'm going to explain what each one of these options mean in the second half of the presentation. For right now, you could just look at this number. This is your retirement allowance estimate. This is for the unmodified option, which pays the most of any of the other options. And if you want to, you can go ahead and put that number into this precision estimate spot on your worksheet. So we knew what your separation date was, your projected retirement date. If you wanted to put in the hours of cash vacation compensation that you included in that estimate, which would be the 56 in this example, you can go ahead and put that in here, and then you put the precision estimate number down here. And this is just the area on your worksheet that just kind of gives you, for the future, it shows you what the numbers were that you used to get this estimate. So that is two ways. Those are two ways to get estimates of your future retirement income. So the ballpark estimate, and then the precision estimate using the benefit estimator. There's a third way that you can get an estimate, which is if you want to submit a retirement estimate request to a SARA, we will do all the calculations for you. The caveats with doing it this way is that what happens is you're using a form from our website. So you can log into your account and fill out the estimate request there, or you can get the form off our forms page. You're submitting that form to Acera. It's going to take some time to get that estimate back because one of our retirement specialists is going to do that calculation for you. They're going to send you a letter in the mail, and there could be a waiting period because they get a lot of these requests. So there might be a queue that you have to wait in. So it could take some weeks to get this back. Versus doing it with a precision benefit estimator in your account that I just showed you. You can log in there and you can have an estimate within like 5 or 10 minutes. That system is available 24/7, and it uses the same software and the same math that the retirement specialist is going to use to calculate your retirement by hand, or I mean, not really by hand, but like you calculate it manually for you. And so you're going to get the same result either way. It's just that if you use the benefit estimator, it's a lot quicker for you and a lot more instantaneous. Okay, so now we're going to talk about the next item in the checklist, which is verifying your retirement eligibility. We're talking about this milestone right here. If you are in tiers 1, 2, and 3, you have 3 different ways that you can qualify to be eligible to retire. Excuse me. The first way that you can qualify is to meet these requirements. You have to be age 50 or older, you have to have at least 5 years of service credit, and you have to have at least 10 years of membership. Now, the reason that there are 2 different numbers here is because for some reason there's this 10 years of membership rule written in the law. If you are somebody who is going to work straight into retirement, so you're not going to quit before you retire, you're going to go straight from active work into retirement, you just have to think about it as working for 10 years and earning 10 years of service credit, because you will also already have 10 years of membership in Acera from your date of entry into the time that you retire. Now, if you're going to stop working before you retire and not retire yet, which is when you stop working and you don't retire yet and you defer your retirement to a later date, we call you a deferred member. So in that scenario, you would have to work at least 5 years, and then you stop working, and then you have to wait another however long it takes to get you up to 10 years of membership, which means 10 years has passed since your date of entry into Acera. So that's option number 1. Option number 2 to qualify is that you can have 30 years of service credit as a general member and 20 years of service credit as a safety member, and you can retire at any age. So you don't have to be age 50. You can retire before age 50. Option number 3 is that you can be age 70 or older, and you can retire with any amount of service credit. And so it can be even less than 5 years of service credit. If you have more than 5 years of service credit, you're probably going to retire in one of these 2 scenarios. So those are your 3 options for tiers 1, 2, and 3. So for tier 4, your first option to reach retirement eligibility is that for general members, you have to be at least age 52. For safety members, at least age 50, and you have to have at least 5 years of service credit. So you don't have to do the 10 years of membership thing. It's just 5 years of service credit. And then your option number 2 is to be age 70, and you can have any amount of service credit, even if it's less than 5 years. So that's how you become eligible to retire. Once you meet those requirements, then you can choose your retirement date and you can retire at any time. So now that we know that what your retirement eligibility date is, you can go ahead and put that right in there. And you don't have to be exact with that again. If you happen to already know that you're eligible to retire, you can leave it blank, or you can put in an approximate date there. So now we're going to move on to the part of the checklist where I'm going to help you choose your retirement date. So we're talking about this date right here, the date that you choose. So we don't choose it for you. You're choosing your retirement date. So there's 7 things that you're going to want to think about when you're finding the best day to retire. So we'll go through each one of these. Number one is it's a good idea. It's not mandatory, but it's a good idea to, think a little bit ahead and do a projection of how much income you're going to have in retirement, just to make sure that you can pay for your life in retirement. Otherwise, you might want to work a little bit more and earn a little bit more toward retirement. So the way to do that is to get an ACERA estimate, contact deferred compensation if you have a 457B account or any other types of investment accounts. Do the Social Security estimator to figure out how much Social Security is going to pay you when you become eligible to collect that. And then you just kind of add it up to see what your income is going to be. And then you're also going to want to think about your post-retirement expenses to think about, is this amount of money adequate to pay for these expenses? And if not, maybe you change plans. Maybe you work a little bit longer, or maybe you move to a cheaper area of the country. I will say that we do have a new area on our website. So this is under the Preparing to Retire heading again. You can get there in this menu, Preparing to Retire, or I showed you, you can get to it in this, with this link right here. So under Preparing to Retire, there is a whole page on estimating your retirement income. And it has links to pension calculators, and it goes into a lot more detail than I'm going to be able to go to here. But I just wanted to show you that that exists. Okay. But just really quickly, what financial planners do say is that you will need 70 to 80% of whatever you're making before retirement. You're going to need that amount of income in retirement to maintain your standard of living. Okay, so the second thing that you're going to want to think about are those age factor percentage dates. And this is only true if you have not yet reached the highest age factor percentage for your tier, or whatever the highest age is for your tier. So if you're in tier 1 and you're over age 62, you're in tier 2 as a general member, you're over age 65, you're in tier 3 and I think it's 55, tier 4, 67, tier 1 for the safety tiers, tier 1 and tier 2B is age 50. If you're already those ages, you don't have to worry about this one. This is for people who are retiring younger than those ages. So let me just give you an example. We'll stick with the January 15th birthday example. Okay, so in this example, January 15th is your birthday. 1 quarter after your birthday is April 15th. 2 quarters after your birthday is July 15th. 3 quarters after your birthday is October 15th. Okay, let's say that you're thinking about retiring in the summertime, and you're thinking about retiring on July 14th. That seems like a good day. No, it doesn't, because if you retire on July 16th, so you work July 15th, you retire on July 16th, you're going to get a higher age factor percentage because you passed this day, which is 2 quarters after your birthday. Okay, so just by waiting 2 days, by changing your plans and adding 2 days, you got a higher age factor percentage, which that alone will increase your retirement allowance by a little over 1%. Okay, just by waiting those 2 days. So you're just going to want to be cognizant of what these days are for you. If your birthday is January 2nd, then it will be April 2nd, July 2nd, October 2nd. If your birthday is February 15th, it would be May 15th, August 15th, and November 15th. So it's based on your birthday. And so you have to work whatever that day is and retire the next day after to get that slightly higher age factor percentage. Or it doesn't have to be exactly the next day after. It could be 2 weeks after or a month after. Now, if you're retiring like halfway in between these days and you don't want to work that extra month and a half to get over the next day, that's fine. All I'm trying to tell you to do with this is, if you're thinking about retiring right before one of these days, don't do that. Because if you just change your plans and like work that extra few days to get past this date, then your age factor percentage goes up and your retirement allowance goes up. Okay. Next thing that you're going to want to think about in choosing your retirement date, the cost of living adjustment day. So to tell you about the cost of living adjustment, it is one of the guaranteed benefits, one of the vested benefits. You get it annually. It's based on inflation in the Bay Area. So whatever percent increase the consumer price index goes up in the San Francisco Bay Area, that becomes what the cost of living increase is going to be. So it's an increase to your retirement allowance that you get every year. And it's posted on April 1st for all members who are in retirement status, and you have to be retired. Actually, this is wrong. It should be retired as of April 1st. So your first day of retirement can be April 1st, and your last day of work can be March 31st. So I need to change that. Sorry about that. So everyone who's in retired status gets the cost of living adjustment every year on April 1st. Now there is a limit to what that cost of living increase can be. For tiers 1 and 3, it's 3%. For tiers 2 and 4, it's 2%. So you can't get more of an increase than that each year. Even if inflation is higher than that, like if inflation is 5% that year, you're still going to get a maximum 2% or 3% increase based on your tier. Now, if inflation is higher than the limit, what happens to the extra percentage, the percentage points that prices increased? Well, those percentage points will actually go into your COLA bank, and we'll save those for you for future years whenever inflation is less than the maximum. So let's say the next year rolls around and inflation is only 1%. Well, if you have percentage points in your COLA bank, we'll take those out of your COLA bank and add them to that 1% to get you up to your limit if we can do that. And we almost always can if you've been retired at least for a few years. So if you've been retired, 2-3 years, almost everyone has percentage points in their COLA bank, and you will usually get the maximum amount of cost of living increase. And this all happens automatically for you. You don't have to do anything to make that happen. Okay, now let me say a couple more things about COLA. One is that a lot of people retire in March. And I think the reason that people do that is because they're already thinking about retiring in the spring. And they're thinking, okay, I'll retire on or before April 1st, and I'll get that immediate cost of living increase. Rather than retiring in April and missing it. Like if you retired April 2nd, you would miss this cost of living increase for that year, but you would get whatever next year's is when that comes around. So for a lot of people, if you're already thinking about retiring in the spring, it just kind of makes sense to retire on or before April 1st. Because you get a higher retirement allowance if you retire like April 2nd or in April or May. Basically, kind of after the first, I'm not sure exactly when the cutoff is, but after the first month or two, you will have earned more retirement just by working more to get more, and that'll give you a higher retirement allowance than it would have had you retired on April 1st. Now, if you're retiring at any other point in the year, January, November, September, August, there's nothing magic about retiring in March or retiring on April 1st. It's just whenever April 1st comes around, you're going to get the cost of living adjustment. So if you're already thinking about retiring in the spring, then it kind of makes sense to retire on or before April 1st. Okay, so then I usually get this question, so I added a slide for it. What happens if you have to choose between the age factor percentage and the cost of living adjustment? So to give you this example again, your birthday is January 15th, and you're a general member, you're age 60. And I'm giving you this example because that means your age factor percentages are still increasing with every quarter year that goes by, because you haven't yet reached the maximum age factor percentage for your tier. And then you're thinking about retiring in the spring. So you're thinking, should I retire? So 1 quarter after my birthday, if it's January 15th, is going to be April 15th. So what I'm trying to choose between, should I retire on April 16th? So I'm going to work April 15th, retire on April 16th. And if I do that, I'm going to get that age factor percentage increase by passing the April 15th age factor percentage increase day. But I'm going to miss the cost of living adjustment that was paid to only people who were in retirement status on April 1st. Alternatively, I can retire on April 1st and I would miss that age factor increase that's going to come in 2 weeks when I pass April 15th, but I'm going to get the cost of living adjustment. So which do I choose? The answer to that is that you probably already know because I told you the percentages. If the cost of living adjustment is the maximum for that year, and we always know that in early February and we'll post it on our website. So if it's the maximum 2% for tiers 2 and 4 or 3% for tiers 1 and 3, you're going to want to go with the cost of living adjustment because you're going to get a 2% increase or a 3% increase from the cost of living adjustment versus the 1% increase or thereabouts that you're going to get from the age factor increase. This is, again, only if you're retiring in the spring and your birthday happens to fall on a day that makes this a conflict. If your birthday was December 15th, that means your next quarter, your day would be March 15th, and you could get both if you're retiring in the spring. So you could retire April 1st, and you would have gotten the increase for March 15th and the cost of living increase for April 1st. So this is only if there's a conflict between these. Additionally, like I said a minute ago, if you work another 2-3 months, you're going to get more retirement allowance than either one of these things because you're going to have if you work another 3 months, let's say you retire in late July in this scenario, you're going to have 3 more months of service credit that you've earned. That's going to make your retirement allowance go up. And you're going to pass 2 age factor increase days, which would be April 16th and July 16th, or April 15th and July 15th. And then that would make your retirement allowance go up 2%. So there's a time after the cost of living adjustment that you earn less money than you would have had you gotten the cost of living adjustment, but that quickly resolves itself. If, like I said, if your age factor percentage is already the maximum, don't even worry about those days. And if you're not going to retire in the spring, don't even worry about April 1st. Just retire whatever day you want. Okay, so the next, okay, so the question is, the quarterly increase only applies if you're below 65. Am I correct? For tier 2, that's correct. So if you look at the tier chart and you'll see the blue box for tier 2 general members, you get the maximum age factor percentage at age 65, which is 2.43%. So if you retire at 65 or older than 65, no matter what day you retire, you're going to get the 2.43%. You're welcome. The next thing that you're going to want to think about is what actual day you're going to retire. So you're going to want to choose this carefully. You're going to want to retire on the day after your last day in active pay status or your last day of work. Okay. So if you're going, this is if you're going straight into retirement. If you're going to defer your retirement, then this doesn't matter. The reason that you're going to want to be careful about this, about going straight into retirement, is we only do that sick leave conversion where you get service credit for your sick leave if you go straight into retirement. If there's any gap between your last day of work and your retirement date, even if it's 1 day, then you lose all your sick leave and you don't get service credit for it. Okay. So that's why your first day of retirement should be the next day after your last day of work or in active pay status. You can be on leave this day. You could be on vacation this whole week. You could be on vacation all 4 of these weeks. But when you're on vacation, that means you're in active pay status. You still have a job that you're being paid through, and you're in active pay status. So whatever your last day of active pay status is, the next day should be your retirement date if you're going straight into retirement. Now, this next one is kind of similar. It's related. What you're going to do is you're going to want to retire that day that you retire. You're going to want to have that be a day that is after a day where you are normally scheduled to work. So like I said, it's okay if you're on leave that day, on floating holiday leave, comp time, sick leave, vacation leave, whatever. Okay, but it's going to want to be on that last day in active pay status. That day should be a day where you're normally scheduled to work. If you normally work Monday through Friday and you want to retire on your first day of retirement be on Saturday, like in this example, that's fine because you normally work Monday through Friday. If you're one of the people, like a lot of people in the medical professions and safety professions have kind of not set schedules, whatever, you're just going to want to wait to pick your exact retirement date kind of toward the time when the schedule is set. And then once the schedule is set, you can see, okay, I'm scheduled to work, like maybe I'm scheduled to work Monday through Wednesday, and then I'm off Thursday that week. Well, then you would want to have the Wednesday be your last day of work, and then the next day would be your retirement date. So an example I'm giving is if you work Monday through Friday, you wouldn't want to retire on Sunday or Monday because you're not normally scheduled to work on Saturday or Sunday. Okay. So that's how that works. They also say that I can't remember if it's your retirement date or your last day of work should be a non-holiday day. I need to clarify that. I apologize. I haven't made that distinction. And I can't remember the reason for that either. But that is something that you can discuss with your retirement counselor whenever you have your counseling appointment. Okay, last thing, don't retire on July 1st, pick any other day. The reason for that is that for a lot of people are trying to maximize the amount of vacation pay that can be included in their salary calculation, like I gave you that whole explanation for. If you retire on July 1st, the limits for how much vacation pay we can include in your salary calculation are lower. That's just kind of like a quirk of the law, and it's because you're retiring exactly lined up with the fiscal year, so you're not straddling fiscal years. But none of that really matters. You don't have to understand that. Just don't retire on July 1st. Pick any other day. June 30th is a beautiful day to retire. July 2nd, wonderful day to retire. Okay. So now we're back to the worksheet. So we filled in the entry date, vested date, retirement eligibility date. Now that you kind of know some more facts and details of how you might want to choose your retirement date, you can go ahead and fill that in right here if you want to do that at this point. Also, if you're going to go straight to retirement, you could fill in your separation date, which now you know should be the day before your projected retirement date. So you can fill that in. Okay, next topic, applying to retire. How does this process work? So let me walk you through this. The first thing that you should do is go to that preparing to retire section. So I already showed you how to get there a couple of ways, but you can just also go to this page. That shortcut should take you to that page. And that, like I showed you, that page has a bunch of stuff on it. Let me just go back there real fast. So preparing to retire. So you just go through this section. It talks about retirement eligibility, considering purchasing service credit. It gives you more explanations on how vacation pay affects your salary, helps you estimate your retirement income, talks about addressing community property settlements, documentation, name change, choosing your retirement date, all kinds of stuff. So you should just go through this whole section. Okay, step 2 is that you're going to schedule that ready to retire counseling session. So this says call us, Sarah. So you can do it over the phone, but we actually have a new process where we recommend that you do it on our website down here and it's in that preparing to retire section. And you go to schedule a ready to retire counseling session. And there is a form here that we have you fill out with some information. And then once you fill it out, we will call you and get your counseling session scheduled. And we schedule the counseling sessions for the 60-day period right before your excuse me, right before your retirement date. So we want you to fill out the form 3 to 6 months ahead of time. And then for that 2 months right before your retirement date is when we're going to schedule that counseling session for. Also within that 60-day period before your retirement date, that is when you're going to want to fill out your retirement application and go through your retirement packet. Your retirement application is one of the forms in your retirement packet, and there are a bunch of instructions on our Retire Now page. And the Retire Now page is the last page on that Preparing to Retire section. So that's this right here, Applying to Retire. And there are a bunch of steps to go through. And this is your retirement packet. And so you're going to complete these forms and follow these instructions. And one of the forms that you're going to complete is your retirement application. And there's even a video over here that will walk you through completing your retirement application. For the retirement application, if you don't want to attend the counseling session, you don't have to. If you feel like you understand everything and you have a handle on it, you don't have to. You can just submit your retirement application. But if you do go to the counseling session, your counselor will review your application and help you submit it, okay? But you're submitting your application within that 60-day period before you retire. We can't accept it before the 60-day period, so it has to be submitted within that 60-day period. Okay, number 4 is you are going to select one of 5 retirement options on this option election agreement form. And you can also submit that, your counselor will help you submit that at your counseling session. Currently, we're only doing phone and video counseling sessions because of the pandemic, but that may change once the situation changes. Hopefully that will be soon. And then once the retirement date passes that you have written down in your retirement application, you're retired. Amazing. And you get to spend the rest of your life as an SRO retiree and get that monthly lifetime retirement allowance. One more thing I'll say about these forms, if you're somebody who's watching this video later, is that we are currently working on combining a lot of those forms in the retirement packet into one form that's more efficient to fill out. So it may look a little bit different in a few months. Okay, so now that you know when it's time to call or fill out the online form to schedule your Ready to Retire counseling session, so it's basically 3 to 6 months before this date. So you can just basically take this date, subtract 6 months, and put it here. And that's how you know when to call in and submit the form. Okay, so I have a question. Two questions. Will the counselor have my actual forms when I have made the appointment? So when you fill out the form, the web form to schedule the Ready to Retire counseling session, no, they will not have your retirement application form yet, because you can't. If you're calling in or filling out that form in that 3 to 6 month period before you retire, you can't have submitted your retirement application yet. It's only the 60-day period before you retire. Now, if you're trying to schedule a session within that 60-day period and it's already 60 days to your retirement date, then they will have a copy of the form. Now, when you go to the counseling session, you should have already, they will communicate with you and will have you already submit your application form. So yes, during the counseling session, they will go through the form with you and make sure that everything is completed accurately and they have everything they need on the form. So if that's the question, then yes. Oh, and then what is your web member services username? It's your email address. And if you have multiple email addresses and you've forgotten which email address you've used, there is a function on that page that will help you remember which email address you used as your username. And if you've forgotten your password, there's also a password reset function on there. Okay, you can expect your first retirement check within 4 to 6 weeks after your last employer paycheck. So you're going to get an employer paycheck sometime after you stop working, and then 4 to 6 weeks after that, you can expect your first retirement check from Acera. Now, what we've changed our process in the last couple of years so that almost everyone, because you're, excuse me, because you are telling us 3 to 6 months ahead of time that you're going to retire by filling out that web form, we start getting the ball rolling on doing all the things that we need to do to get you your retirement check by the time that you retire. And so almost everyone gets 100% retirement check of whatever their retirement whatever their full retirement amount is. They get that immediately. Now, some people, if we have missing documentation, if there's divorce orders pending, if you made a late service credit purchase or other issues, you can still retire and you can still start getting retirement checks. It's just there'll be 80% payments until we resolve the issues. And then we'll get you up to your 100% payments and make any retro payments for any less than 100% payments that we made. Okay, so the next thing that I'm going to show you, your 5 retirement allowance options. So on that option election agreement, you're going to choose one of these 5 options. And this is, you choose this at the time of retirement. You don't choose it before, you don't choose it after. And then and when I say you don't choose it before, I mean you don't choose it way before. You choose it like within the 60-day period prior to retirement. This is your one opportunity to choose your option, and you can't choose a different option later if you change your mind. So whatever option you choose, that's going to be what it is for the rest of your life. Okay, so I'm going to show you these 5 options, the unmodified option and options 1 through 4. For each one of them, I'm going to show you a slide with a table on it. It has a lot of text. The top row is going to talk about your retirement allowance as a retiree. And the bottom information will talk about what your beneficiaries will be eligible for after you die. So your beneficiary, a beneficiary just means somebody who gets benefits. And so your Acera beneficiary is somebody who gets your Acera death benefits after you die. So the first option is the unmodified option. This pays the maximum retirement allowance of any of the retirement options, any of the 5. This is what most people pick just because it pays the most. So what this leaves to your beneficiary is a 60% monthly continuance to a qualified beneficiary. So whatever you were getting as your retirement allowance, your continuance beneficiary is going to get 60% of that every month for the rest of their life, if it's a spouse or state registered domestic partner. So a continuance, that word just means a continuing payment. So you're, as a retiree, you're getting your monthly retirement allowance, and then after you die, they're going to get a monthly allowance, which we call a continuance, a continuing payment. And it's going to be 60% of whatever you were getting. Now, if a qualified, so who is qualified to get this? Your spouse or your state registered domestic partner who you have married or registered at least 1 year before your retirement. They will get the 60% continuance for the rest of their life. If you don't have a spouse or state registered domestic partner, you can name your minor child or minor children. But it's not for the rest of their life, it's temporary, and it'll stop at age 18. Or it can continue until age 22, as long as they maintain enrollment as a full-time student in an accredited school. But it will, and then it'll stop at age 22, or it will stop if they marry a registered domestic partner. Okay, then that's continuances. If you don't have one of these people to name as a beneficiary, but you still want to take the unmodified option, totally fine. Lots of people do that. You can still even name beneficiaries. It's just you can't name them for a continuance because it can only be one of these people. You can name a beneficiary for a lump sum payment. And The beneficiary can be anyone, and it's a one-time lump sum payment. And what it's going to be is the balance of your account. So it's going to be your employee contributions that you've paid into your Acera contribution account throughout your entire career, plus all the interest that we have paid into that account that your money has earned over the years, minus any of the retirement allowance payments that we've already paid you out. So whatever the balance is that's left over. If you die after the first 3 to 5 years of retirement, there will not be a balance left over, because all of the money that is in your contribution account will have gotten paid out to you in retirement allowance payments. So that's the bad news for your lump sum beneficiary. The good news is that for your entire career, you paid into this system, this fund, and we're going to give you all that money back within your first 3 to 5 years of retirement. And then everything that you're getting paid after that is just basically like pure profit for you. It's amazing. And it's because of the employee contributions, but mostly because of the interest that we earn, because we professionally manage your money, and the interest actually pays for 75% of your retirement allowance. So being able to participate in a defined benefit pension plan like Acera is a really special thing. And you really get to like accelerate your retirement savings and by contributing to this, and then you get to have a secure retirement for the rest of your life that you can count on. So it's a really special thing. Okay, there's one more thing I want to say about this. There is a scenario where at the time of retirement, you named your spouse or state registered domestic partner or minor children as your continuous beneficiary, but then in retirement, they pass away before you do. So if they die before you do, you can name a new beneficiary, but only for lump sum payments. The only opportunity for you to name beneficiaries for a continuance is at the time of retirement. So if you get married, if you're not married now, you retire, you get married after retirement, same thing applies. You can name your new spouse for a lump sum payment only, lump sum payments only. If that scenario happens to you, it's still important to name beneficiaries for lump sum payments, because it's not actually just this balance that would be paid out to lump sum beneficiaries. There are other amounts. One of them is the $1,000 lump sum death benefit that I showed you was guaranteed. So that's $1,000. Any partial monthly payments, because if you died halfway through the month, for example, that would be like a half month's worth of retirement allowance that we owe you that we didn't get to pay you out. So that would go to your beneficiary. If you enroll in our healthcare plans, you pay those premiums to us a month in advance, and so you would get refunded that. So there's other little amounts that would get paid out to your lump sum beneficiary. Okay, option number 1, which is the next option. This one's subtitled lump sum to beneficiary, because this does not pay a continuance to anyone ever at any time. So this is the only option that never pays a continuance to anyone. What this does is it pays a little less to you in your retirement allowance than the unmodified option does. You'll see if you do an estimate of this, it'll be a tiny bit less. What this does is it provides a larger one-time lump sum payment to a lump sum beneficiary. So there's some like accounting magic that happens here that extends that 3 to 5 years that it takes to exhaust your contribution account to 10 to 12 years. So if you died within the first 10 to 12 years, there would be a big lump sum left there to refund to your beneficiary. Option number 2, this one is subtitled 100% to your beneficiary. So you saw that the unmodified option paid 60% to your beneficiary. This one pays 100%. So you're getting your retirement allowance as a retiree, and then when you die, whoever you name as a beneficiary will get 100% of that amount for the rest of their life. Now, this is going to pay less to you than the unmodified option. And the amount less that it pays is based on your beneficiary's life expectancy. So if you name somebody much younger than you, they're going to have a longer life expectancy. We're going to expect to have to pay them out for a longer period of time. So when we do the calculation for your retirement allowance, we're going to pay you less. And that reduction starts at the time of retirement. You can name anyone as a beneficiary. Although if you have a spouse or state registered domestic partner, they would supersede anyone you have designated as a beneficiary. If the person is significantly younger than you, your reduction might be pretty sharp. And then if your beneficiary dies before you do, we don't change what your retirement allowance is because your beneficiary died younger than their life expectancy. Whatever your retirement allowance is at the time of retirement, that's what it's going to be, plus cost of living increases. So that's option 2. Option 3 is the exact same as option 2, except rather than paying 100% to your beneficiary, it pays 50% to your beneficiary. But again, you can name anyone as your beneficiary. So the difference between options 2 and 3, the difference between those and the unmodified option is with the unmodified option, for a continuance, you can only name spouse, state registered domestic partner, or minor children. For option 2 and 3 and 4, in fact, when I get there in a minute, you can name anyone. But then everything about option 3 is the same as option 2. Excuse me. Now, this is going to pay less than the unmodified option, but this is going to pay you more than option 2 as a retiree because we're paying less to the beneficiary, so you're going to get more in your retirement allowance. And then option number 4, the final option, is where you can name multiple beneficiaries for a continuance. So you can have multiple beneficiaries. For all the other options, you're only naming one beneficiary for a continuance. And the exception to that is the unmodified option. You can name multiple minor children, but for the lifetime continuance, you can only name one person for those other options. For option number 4, you can name multiple beneficiaries for a lifetime continuance. So if you had 2 children, for example, and 2 adult children, and you can't name them under the unmodified option, you could name them for a lifetime continuance under option 4. And you would specify the dollar amount or the percentage to go to each beneficiary. And then all the same rules apply as options 2 and 3. And the amount less than the unmodified option that this pays to you as a retiree during your lifetime is based on your youngest beneficiary's life expectancy that you name. Okay, so those are the 5 options. Now, that's kind of like the the theoretical framework around like what these pay out. If you want some concrete numbers, the best way to do it is to go to the benefit estimator. So we've already seen the screenshot, and you do a retirement scenario for yourself with your separation dates and your projected retirement dates. And what you're going to do is fill out this information. So you put your beneficiary's name, their relationship to you, and their date of birth. Now there's a drop down here. You may have already named, and hopefully you should have already named beneficiaries for your death benefits as an active member, because if you should pass away before you retire, your beneficiaries do have access to a bunch of different death benefits. So you should keep your beneficiary up to date. If you've already named your beneficiary, you'll see them in the drop down here, perhaps. And if you're going to select one of them, this information will fill out automatically. Make sure the date of birth is correct, because some of them are not correct, and that'll throw off the estimates. So then you click Get an Estimate. And again, you're getting this PDF benefit estimate, so you can make as many of these as you want. for however many scenarios as you want. And if I zoom in here, so again, this is your retirement estimate, like these numbers here. So now these probably make a little more sense now that I've explained the different retirement options. So you have the unmodified option here. This is your estimate for how much your retirement allowance would be under the unmodified option. This is an estimate of your beneficiary's retirement allowance. So this is going to be 60% of this. For option number 1, this is an estimate of your retirement allowance. Option number 2 and 3, again, estimates for options 2 and 3 for your retirement allowance and then for your beneficiary's retirement allowance. And you'll notice that option 2, they're the same because it pays 100% to your beneficiary. Option 3, you'll notice this is half of this because it pays 50%. You'll notice the unmodified option pays the most. You'll notice that option number 1 pays a little bit less than the unmodified option. And there's 2 more numbers here for you. If you are interested in selecting option 1, this tells you the total balance of the account that we're going to pay money out of every month. And this tells you how much we're going to pay out of that account monthly, that this amount is going to be reduced by. So if you were to die within that first 10 to 12 years, there would be an amount left here to go to your lump sum beneficiary. So if you want to figure out how long this is going to last, this money is going to last, you just take this big number and divide it by the little number, and that tells you how many months it's going to last. And then you could even divide that number by 12, and that'll tell you how many years it's going to last. So that is the retirement benefit estimate and the different options. Okay, so understanding your other benefits. Now we're going to talk about the healthcare benefits, medical, dental, vision, and other benefits. I'm going to pause for 1 minute though, and I'll be right back in like 1 minute. Okay, I'm back. Okay. So I talked a lot about guaranteed benefits, the retirement allowance, the cost of living adjustment, death benefits. We also have a variety of non-guaranteed benefits, also known as non-vested benefits. So these are extra benefits that the county and the other employers decided at some point in the past that the retirees needed access to be able to have these. And so they created a reserve fund that pays for these benefits. The Board of Retirement, which is Sarah's board, which is separate from the county's board, what they do is they administer this fund. So they do actuarial projections every year to see how much is coming out of the fund and how long the actuary thinks the fund is going to last. And their goal is to ensure that the fund stays sustainable so that these that they can continue offering these benefits into the future. So they're the ones that determine the benefit levels and what the benefits are in order to assure the fund sustainability. So the benefits may be reduced or eliminated in the future to ensure sustainability. So that's where the non-guaranteed part comes in. It's just as long as there's funds available, then they can offer these benefits. Now, I will say that currently there's like almost $1 billion in this fund, and the fund, the board considers that if the actuary projects it's going to last at least 15 years in the future, that it's considered sustainable, and the current projection is 19 years. So it is considered sustainable at this point. Which means they would be unlikely to reduce or eliminate benefits. Okay, so there are 5 different benefits here. There's a medical subsidy. MMA stands for monthly medical allowance. There's a dental subsidy, vision subsidy, Medicare subsidy, and supplemental cost of living adjustment. And this slide just kind of outlines what they are and how many years of a SARA service credit it takes to qualify to be eligible to receive these benefits. Because this is the board's rules for who gets the benefits in order to ensure the fund sustainability. So you can see that for the supplemental cost of living adjustment, everyone is eligible to get that. But for all of the other benefits, they start at 10 years of service credit. So you have to have at least 10 years of a SARA service credit, and that reciprocal service credit with other agencies doesn't count. So it's a SARA service credit, and then you qualify for the first level of the monthly medical allowance, and then the dental, vision, and Medicare subsidies. And then if you achieve 15 or 20 years of service credit, then you get higher levels of the monthly medical allowance. So let me talk about each one of these. So first we have the monthly medical allowance. So again, it's not guaranteed. What this does is it offsets the cost of being enrolled in a SARA-sponsored retiree medical plans. So it doesn't go to cover the cost of any outside plans. And for the group plans, it offsets the cost of premiums. So we contract with carriers to have group plans. We also have individual plan options, and it will offset the cost of your premiums, copays, and deductibles. And a premium is just simply the monthly cost that it costs you to be enrolled in the plan. They call that a premium. The amounts of the subsidies are set annually by the Board of Retirement. Any costs exceeding how much the subsidy will pay for, you are responsible for paying. And the monthly medical allowance only goes to cover your costs as a retiree. It doesn't cover the costs of your beneficiaries, survivors, former spouses, dependents, anyone else, although you can enroll them in the coverage. So here are the monthly medical allowance amounts for 2020. The full monthly medical allowance that you are eligible for if you have at least 20 years of a SARA service credit is $578.65. 3/4 of that amount, which is if you have at least 15 years of a SARA service credit, $433.99. 10 years is $289.33. And if you have less than 10 years of a SARA service credit, you're not eligible for the monthly medical allowance. So let me show you what the plans are, the plan options. So we have open enrollment in November of each year. That's your opportunity to change plans, add coverage, take away coverage. But you can also enroll directly into a plan at retirement. And so we will get you into a plan without any gap in coverage. So you can start your plan immediately upon retirement. And we have a healthcare unit that will help you through that. So we have two categories of plans here on this table. We have the ones that are for people who are not Medicare eligible, which generally happens at age 65, and the plan options for people who are Medicare eligible. So let's talk about the non-Medicare options first. I'll talk about the non-Medicare group plans first. Then I'll talk about the Medicare group plans, and then I'll talk about the individual plans through VIA benefits separately. I can't go into the full details of all of these plans. I'm just going to show you basically like what the costs are. If you want the full details, we publish an enrollment guide every single year, and so you can get to that on our website. Okay, so for the non-Medicare plans, here are the group plan costs. There's 3 non-Medicare group plans. There's one Kaiser Permanente plan, it's Kaiser Permanente HMO. The self-premium is $785.44. And then there are 2 United Healthcare plans, Signature Value HMO and Signature Value Advantage HMO. The self-premiums are $1,087.80 and $831.92. Okay, so you can see that even with, to go back 3 slides, even with the full monthly medical allowance amount, which is $578.65, it does not cover the full cost of being enrolled in any of these plans. So you would pay the difference. The Kaiser plan is the cheapest, followed by the Signature Value Advantage plan. And the difference between these 2 plans, these 2 United Healthcare plans, is not much, except for this one's way cheaper, the Signature Value Advantage plan. It's 23.5% cheaper. And what you have to do is stick to this, this designated network of high-performing providers. And when the county studied this, and they're the ones that negotiate all these plans, they found that people enrolled in the Signature Value plan were sticking to that network anyway. And so, like the vast majority of people. And so they negotiated this option to have this Advantage plan that would be a lot cheaper as long as you stick to that network. And copays are $15 for those plans. You can enroll self plus one and family if you want. Now for the group plans, the way that you pay for the plans and the way that you are subsidized, if you can get the monthly medical allowance subsidy or any of the other subsidies, goes in and out of your ACERA paycheck. So this is like a super basic rudimentary version of your pay stub that I'm showing you. So you have your gross pay. This is your retirement allowance. And then you're going to have some columns like you see on your current paycheck. You're going to have a deductions column. So if you enroll in the Kaiser HMO plan, for example, you would see that self-premium come out of your check, $785.44. Then you also have an additions column. So in this example, this person's eligible for the 20-year monthly medical allowance, $578.65. So that goes back into their check. And then so your net pay ends up being your gross pay minus the difference between these two, between how much it costs you and how much your subsidy is. So you end up paying the part of the premium that the monthly medical allowance doesn't cover. And one thing I'll say about this is all of these subsidies are not taxable. So we have it worked out with the IRS where this is not taxable income. So you do not have to pay income taxes on ACERA subsidies. Okay, so like I said, these group plans, these non-Medicare group plans, are group plan options. And for group plans, you have to live in a certain service area. So the service area for these plans is only in California, and it's the Bay Area, Fresno, Sacramento, Southern California, and for Kaiser, I think they have Santa Cruz also. If you live outside of the service area, and it's based on your zip code, you cannot enroll in these group plans. But you do have individual plan options outside the service areas and in the rest of the nation. I'll show you what those are in just a minute. What I'm going to show you first are the Medicare plan, Medicare group plan options, because it makes more sense for me to explain the individual plan options combined between non-Medicare and Medicare. So I'll just do that all at once. So before we get there, if you, once you're Medicare eligible, you're age 65 or older, and you want to enroll in one of our Medicare plans, you can do so. If you don't want to, if you just want to take the straight Medicare coverage that the federal government offers, that's totally fine. What these Medicare plans do is they give you a higher level of coverage than just straight Medicare does. So it's like extra coverage that Medicare doesn't quite offer. The premium, so the only group plan option for Medicare group plans is Kaiser Permanente Senior Advantage Plan. And self premium for 2020 is $411.54. Now in this chart, I've given you some extra numbers just to illustrate a few points. So I've taken the premium amounts for a bunch of different scenarios and put them in this row. So this is if you enroll yourself. These three are if you enroll yourself plus one. So that would be yourself and your spouse, or state registered domestic partner, or sometimes children. I'm not sure if they count as plus one. If you have one child. Probably though. I would have to, if you want to know the answer to that, send me a message through the Q&A. And then self, and then these ones over here are self plus one plus family. Okay, so that's what these premiums are. And the different scenarios are if you both have Medicare, if only one of you has Medicare, and if you're the one who's Medicare eligible, or if your spouse is the one that's Medicare eligible. So that's why there's 3 columns for each one of these. And so this is the premium amounts for each one of those scenarios. So what I've done is I've taken the monthly medical allowance and actually put it in this row here to show you what the cost to you would be in these different scenarios. For this, let's look at the self with Medicare premium first. The premium is $411.54. And I put in here the monthly medical allowance also being $411.54. Now, you probably don't remember seeing that on the monthly medical allowance table. That's not one of the amounts here. But the reason for that is because the monthly medical allowance only pays up to the amount of the self-premium. It doesn't pay over the amount of the self-premium for the group plans, so you do not get to keep the change. So that's why if your premium is $411.54, the monthly medical allowance becomes $411.54 because it only pays up to that. This would be the same if it was 15 years. So essentially, if you have at least 15 years of service credit and you're Medicare eligible, this costs you $0 to enroll. And so you might as well enroll in it and get a higher level of coverage than Medicare alone. If you have the 10-year monthly medical allowance, it may still be worth it to you to pay the extra $100 or a couple of $100 to enroll in this, out of pocket to enroll in this plan, to get that extra level of coverage. And then over here, you'll notice that the monthly medical allowance is higher. It's because in this 20-year example, I've put in the full 20-year monthly medical allowance, and that's because in this scenario and this scenario, you have a spouse who you're enrolling, and it's your spouse that's eligible for Medicare and not you. You're not yet eligible for Medicare. So what happens is they would put your spouse in the Kaiser Permanente Senior Advantage Plan, and you would actually go in the non-Medicare plan, which has a higher premium, and so that allows you to get the full monthly medical allowance amount. Okay, so that's how the group plans work. Okay, so now I'm going to talk about your individual plan options if you are not Medicare eligible and if you are Medicare eligible. So the first question to ask is, who can enroll in an individual plan through VIA Benefits? VIA Benefits is the private health insurance exchange that we contract with to offer these individual plans. Who can enroll? If you're not yet Medicare eligible, you can enroll if you live outside of our group plan service areas. So if you live in California outside of those group plan service areas, like you move up to Redding or Chico, those are not in the group plan service areas. Or if you move outside of California into one of the other states in the United States, that's outside of the group plan service area. So that gives you the opportunity to enroll in an individual plan because we don't have a group plan option for you. So we only have the individual plan options for you. Now, if you're Medicare eligible, you can enroll anywhere in the United States, even if you live in the group plan service area for Kaiser. So that doesn't make a difference. So you could live in Livermore and you could enroll in an individual plan if you so choose. But you must maintain enrollment in Medicare Parts A and B. Okay. So how does VIA Benefits work? How do these individual plans work? So VIA Benefits is this private health insurance exchange. They have plans across the entire nation. And the way the enrollment works is by telephone or online. Especially if you call in by telephone, what you do is you talk to a certified, salaried, non-commissioned, non-biased benefit advisor. And I say all that to say that they don't get a commission based on which plan they put you in, which company you go with. They just get a salary. So they don't care what plan you go into. They just want to narrow down the plan's options to what's right for you. So when you call in, you tell them where you're going to live, how much coverage you're going to want, how much you're willing to spend. You can even get down to what providers you want to visit or what prescription drugs you need. And they will help narrow down their 1,000 plan options into just a few options that are right for you. And then you're going to pay the monthly premium to the carrier rather than to Acera out of your Acera check. And the monthly medical allowance for the individual plans, and I said this earlier, it covers not only the cost of premiums, but also if you are in a deductible plan, it'll cover deductibles and copays. Okay. So if you are eligible for the monthly medical allowance, the way that is paid to you works a little bit differently. It's not paid to you in your Acera retirement check. So this rudimentary illustration is going to illustrate that point for you. Hopefully it's not too basic. Okay, here's Acera. Here's your monthly medical allowance that you're eligible for that we need to pay to you. Okay, so what we're going to do is VIA Benefits is going to open up a health reimbursement account for you in HRA. And so Acera is going to send your monthly medical allowance over to VIA Benefits and put it in your health reimbursement account. Okay, here's your bank account. You're going to enroll in an insurance plan, and that's going to come with a monthly cost that you're going to pay directly to an insurance carrier. So that's your monthly premium. You're going to pay that out of your bank account. You're also probably going to go to the doctor and use your plan, use your coverage. And so your doctor is going to charge you a copay. Okay, so now you're out some money. So if you're eligible for the monthly medical allowance, you can submit reimbursement claims to VIA Benefits, and they will pay you money out of your health reimbursement account. They will pay you your monthly medical allowance back to your bank account. And you can set up a lot of this stuff to happen automatically. You can have reoccurring reimbursements automatically happen to your insurance company. You can have auto reimbursements direct deposited to your bank account. And so you would only be responsible for submitting like copay reimbursements for copays to VIA Benefits. And they have an app that you can do it electronically, and you can do it on their website electronically as well. So they try to make it simple for you. So that's how that works. So one more thing about the monthly medical allowance. If you are Medicare eligible and you want to sign up for an individual plan through VIA Benefits, those plans are so inexpensive that the Board of Retirement has decided to have a lower set of monthly medical allowance amounts for those people. So here are the monthly medical allowance amounts that are a little bit lower. So 20 or more years of service, the full monthly medical allowance amount would be $443.28. Now what we find is that the average cost of these plans is about $200 a month. So there's a lot of money left over if you have the full monthly medical allowance or even the 15-year monthly medical allowance to pay for those copays and deductibles. And we find that over 90% of the people don't run out of monthly medical allowance, and it covers all their costs. So that is medical coverage and the monthly medical allowance. So now I will move on to talk about our dental plans and dental plan subsidies. If you have 10 or more years of Acera service credit, you must enroll in one of these two dental plans. These are the two that we offer, Delta Dental PPO and Delta Care USA. But it doesn't cost you anything. So this column right here is telling you what the self-premium is for these plans and also what the subsidy is. Subsidy is the exact same amount as the self-premium. So for example, if you have at least 10 years of Acera service credit or a service-connected disability retirement, and you enroll in the Delta Dental PPO, you would see 4204 come out of your check in the deductions column for your premium amount, which we will send over to Delta Dental for you. And then in the additions column, you would see 4204 go back into your check as your subsidy. So you would pay zero. The same thing with Delta Care USA. If you want to enroll your Self Plus One or family into that coverage, you can. And you would just pay the difference between these two. So if you're enrolled Self Plus One for the PPO, 8104 would come out of your check, 4204 would go back into your check. And you end up paying the difference. These columns over here is for if you have less than 10 years of Acera service credit as an Acera retiree. You can voluntarily enroll in one of the Delta dental plans, but you have to pay the full amount of the premiums because there is no subsidy offered. So that is how dental coverage works. Now the vision coverage is very similar. If you have at least 10 years of Acera service credit, you must enroll in at least the VSP standard plan, but it costs you zero. So again, $4.24 is the amount of the self-premium and also the amount of the subsidy. Now for the vision, there is a higher plan with more coverage. It's called the VSP Premium Plan, and you can buy up into the VSP Premium Plan. The subsidy is going to stay the same as $4.24. And so if you enrolled in this plan, $14.78 would be your premium and $4.24 would be your subsidy. And so you would pay the difference between these two. And again, if you have less than 10 years of Acera service credit, you can still enroll, but you pay the full amount of the premium yourself out of your check. Just to give you like a basic difference about the coverages between these two, for VSP standard, I think you get frames every 24 months, the plan covers, and for the premium plan, you get frames every 12 months. And so again, you can see the differences between what the plans cover in that enrollment guide. Okay, so we covered medical, we covered dental, we covered vision, the plans and the subsidies. The fourth non-guaranteed benefit we're going to talk about is the Medicare Part B reimbursement plan. So when you are Medicare eligible as a retiree, and you go to enroll in Medicare when you turn 65, you're going to enroll in Medicare Part A, which is for hospitalization. Medicare Part B, you're also going to enroll in Medicare Part B, which is for doctor's visits. And then for some plans, you would enroll separately in a Medicare Part D prescription drug plan. Excuse me. So for when you enroll in let me start over. If you have paid into the Medicare system throughout your career, I think for at least 10 years, Medicare Part A will be free for you. If you haven't, you can still enroll in Medicare Part A, but it will cost you. There will be a monthly charge. Okay, now for Medicare Part B, which is the doctor's visits, for everyone, there's going to be a monthly charge. And for 2020, the lowest level of that charge is $144.60. And it's based on different income levels. Most people go into the $144.60 category. The second tier is whatever the income level is pretty high. So what the board has offered is that the subsidy they're going to offer you a subsidy for you having to incur costs for being enrolled in Medicare Part B. And they offer it at the same level as the lowest Medicare Part B premium amount, which is $144.60. So the bottom line is that if you have at least 10 years of ACERA service credit and you enroll in Medicare Part B and you submit an application for this just to enroll in it, it's a one-time application, Medicare will charge you $144.60 out of your Social Security check every month, and then ACERA will put $144.60 into your ACERA check every month. And so it doesn't end up costing you anything to be enrolled in Medicare Part B. Okay. One more thing about Medicare, and I'm not going to go into Medicare really at all in this seminar, and that's because if as a retiree, whenever you go to turn 65 and you become Medicare eligible, 2 months ahead of time, we're going to send you an invitation to attend our Medicare transition seminar. Currently we're doing them only online because of the pandemic. But you can sign up for that and attend that, and we'll help you transition over into Medicare, and we'll help you remember to, and we'll help you submit this form so that you can start getting the subsidy right away. If you are already 65 and you're still working and you're going to retire later, you're not going to get an invitation to enroll in that transition seminar, but it's a good idea leading up to retirement to go ahead and attend the seminar. And you don't, at this point, we have videoed it, so we offer it as a video seminar on our site, and so you can watch it at any time. You don't actually have to watch it live. So you can go ahead and watch that at any time. Okay. The last non-guaranteed benefit I'll talk about is the supplemental cost of living adjustment. This is paid on top of the vested cost of living adjustment. What this does is it helps you maintain your buying power in retirement. So if at any time in retirement, inflation has gotten so bad that you have lost more than 15% of your buying power to inflation, the supplemental cost of living adjustment kicks in and keeps you at 85% of your original buying power at retirement. And if you're retired long enough, this will happen to everyone. Just because of the nature of inflation in the United States, it's about 3% a year. So I think everyone all the tier 2 retirees who retired before like the late 90s, if I recall correctly, have the supplemental cost of living adjustment keeping them at 85% of their original purchasing power. Okay, so we just have a couple more things here. And it's good timing because we're almost out of time. So the first thing is I'm going to just talk really briefly about these various life events. Because these don't necessarily apply to everyone, I'm just going to let you know that there is more information out there to be had about each one of these that you should probably access on our website if one of these applies to you. So if you are going to stop working before you retire, you're not going to go straight into retirement. You become what we call a deferred member. You stop working, you're not ready to retire yet, you're deferring your retirement to a later date. There are some things you should know about deferring your retirement. You can retire out of deferred status. It's just that there are some things that you should know about that. And so you should go ahead and check out that page on our site about deferring your retirement. And one thing that I'll say for anyone watching this live is that if any of these links don't work, I'm going to go, since we relaunched our website, it's possible that some of these links got, kind of mishmashed. And so I'll go in right after this seminar and just make sure all of them work and reroute them to make sure that it's getting to you to the page. So just like wait an hour after the seminar is over to click on this stuff. Okay. So the next life event I'll talk about is if you should die before retirement. So this is not something that you're necessarily going to know is going to apply to you unless you can predict the future. And if you can, please see me after class. And I have a lot of questions. So this is something that probably everyone should explore. And so there are some death benefits that are offered to your beneficiary should you die before you retire. And so you should probably just know what those are. You should probably familiarize your beneficiaries with that and just keep your beneficiary up to date and make sure that we currently have your current beneficiary on file, the person that you want to receive your death benefits. And the way to do that is to log into your account on our website, and it'll say who your beneficiary is on there. Okay. Now, if your beneficiary in your account is your spouse from 3 spouses ago, for example, you're going to want to go ahead and redesignate your beneficiary. And so you can do that with our beneficiary designation form, and on that page it will help you fill out that form. Okay. So if you divorce or dissolve your domestic partnership, or if it's something that you're considering, go ahead and check out our divorce page, because there's some information you should know about how divorce affects your SARE benefits, because any retirement that you earn while you're married or in a state-registered domestic partnership is considered community property that will be on the table for division in the event of your divorce or domestic partnership dissolution. So you should familiarize yourself with that. Disability retirement. If you, at any point in your career, you become permanently disabled and you cannot perform your job duties, you do have the option of applying for disability retirement and retiring early based on that disability. And so it's a really good idea to go ahead and review the information on our disability page. And if it's something you're seriously considering, you should call in to our office and ask to talk to the disability unit, and they can help you through that process. If you're going to work after retirement, if you're going to go to work for anyone except for one of our 6 participating employers, have at it. Hopefully you don't have to work after retirement. It's something that you want to do. But should you work after retirement for anyone except for our 6 participating employers, we're just going to consider you an ACERA retiree, and you can go do whatever you want. We're going to pay you that retirement allowance every month for the rest of your life. Now, if you're going to go back to work for your employer or one of our other participating employers, there are restrictions and duration limits on whether you can go back to work and how long you can go back to work for. And so you should review those on this page. Okay. If you're going to relocate after retirement, it's important that you fill out our address change form so we can communicate with you. So we can send you our annual report, any newsletters that we're going to publish, and most importantly, our open enrollment packet that we send out every October to prepare you for our November open enrollment, and then any other official correspondence that we need. The last thing I'll tell you about is if you want to keep up to date with what's going on with ACERA, the best way to do it by far is to subscribe to our ACERA news. All you do is you go to acera.org/subscribe, and then there are 5 different categories for depending on what kind of news you want to get. If it's for retirement planning, if it's for keeping track of our investments, if it's for news for retirees. So you can choose which news you want. And we only send out important stuff. So you're not going to be inundated with a bunch of emails. So if you just want to keep track of what's going on with ACERA, go ahead and subscribe. Otherwise, you can just check our news page. The one area in there where you may get a bunch of emails is there's a wellness. You can select to receive news on wellness. And we have a wellness page. We have an entire wellness site on our website for our retirees. And if you want to get those wellness tools and articles and tips, we send those out periodically. We don't send them out a bunch. And so you can go ahead and subscribe to that wellness, get that wellness information. If you have more questions at any point during your career, after your retirement, we're here for you. We have a customer service department that is dedicated to answering your questions. So you can just call us at 628-3000. Currently, we are only taking live calls on Tuesdays and Thursdays. So today is July 30th. And that's just because of the pandemic and because of our staff resources. But we're working on getting a virtual call center up and running, and we would be back to taking calls 5 days a week. And so you can check our website to see where we're at with that. So on behalf of Acera's Board of Retirement and Acera staff, we wish you a really beautiful retirement and an amazing retirement. And I want to thank you for your time, and thank you for being here with me during the pre-retirement seminar. And I wish you a beautiful retirement and a beautiful life.